Okay, welcome back. The market's up, 50 points. Things are looking pretty solid, 11,598. Well, Rahul Arora is CEO at Nirmal Band Institutional Equities, and he's joining us right now to take some questions. Rahul, thanks very much. Good to have you here. I mean, so the market moves on, and people have been waiting for that correction, a pause, nothing. I mean, it's just chugging along. And one has to say, I mean, the expansion, or rather the explosion in market breadth and the number of stocks which are now participating is truly impressive, whichever way you slice and dice the data. Your thoughts?
Morning, Prashant. Thanks for having me on. It is surprising, but I think somewhere there is an element of despair in the people that weren't expecting it to rise as much as it did. The fact is we are within 7% of making new all-time highs. And, were we having this conversation on the 23rd or 24th of March, and you said 5 or 6 months on, the Nifty would be up 55-60%. I don't think there would have been too many takers for that. As you correctly pointed out, I think in this journey of this 55-60% rally, Prashant, there's been reasonable sector rotation. So it's not been dominated just by one particular sector. It started off with consumer, then banking, which had led the fall, came back. Pharmaceuticals has participated, Reliance has participated. The telecom breadth is starting to expand. And then, of course, the broader markets have caught in, and the multiples have expanded manyfold. But I'll tell you something, Prashant. What concerns me a little bit is typically as sell-side brokers, we tend to value stocks on a one-year forward basis. If you start valuing stocks on FY22, and I've been speaking to some of my friends and other sell-sides as well, there are not too many buy recommendations you can give on FY22. So what the street has done is, when you look at buy recommendations, they've either moved to the average of FY22 or 23, or some have rolled over to FY23 completely. That is a bit worrying when you're discounting 30 months out of earnings, sitting where we are still in the middle of the pandemic. I do understand we're getting closer to the opening. I do understand that $3.5–4 trillion worth of global liquidity has been put into the system. The RBI governor on your channel a few days back spoke about the liquidity-induced rally and the fact that he himself was concerned and said, watch out for a correction if it happens. So, there's a bit of despair for people who were expecting a bit of a dip. As you said, it's been a one-way march all the way to the greens, but make hay while the sun shines. It's not going to last in a linear fashion. I don't think this is going to take out the previous high of 12,400 in this run, Prashant. I think we're getting somewhere close to the top. Now, whether we correct from here or we consolidate here is a matter of an academic debate. But that being said, I think fresh retail money from here should be very, very careful when they're entering just about 7–8% from the all-time highs.
Rahul, morning. Thanks so much for joining in. So fresh retail money, where should it go? Because one can't time whether the markets are going to consolidate from these levels or there is going to be a correction. So what would you recommend putting money in right now?
So, Rima, I think if you were looking at the broader markets, since, Prashant also referred to that in the first question, I think as we are getting closer to the opening up phase of the economy, I would actually look at stocks and sectors that have very inherent strengths or are market leaders and got beaten the pulp out of them on the way down and are still trading at reasonable valuations. These could be hospitality-related stocks, these could be travel and tourism, these could be multiplex-related stocks, and you will get all of these stocks in the market cap range of between 3,000 to 4,000 crores all the way up to 15,000–20,000 crores. So I think from an immediate trade perspective, I think you could look at names like, say, an Indian Hotels, maybe a PVR or an Inox. Or even, I heard you guys talking about real estate a little while back. If this little bit of cut in stamp duty was to result in a little bit of revival of demand on the residential real estate side, you could even look at real estate ancillary plays, whether they are ceramics or plywood or even paints for that matter. So I think from an immediate trigger standpoint from the broader market, there is enough and more to play despite the fact that the market is at 11,500. On the large cap side, it's a slightly tougher call to take. I think, the place to hide in the last rally, apart from Reliance, has been IT. I think that may continue to be the place to hide for some time because people are really struggling to put valuations on pharmaceutical stocks now. Some of these stocks have gone up 2x, some of them have gone up 5x. So I think in the large cap space, there's not too much place to hide right now. Maybe IT is the only place. And in mid caps, like I said, some of these opening up themes may not be a bad place to be parking your money.
Any undervalued names that you want to highlight, one or two, Rahul, for our viewers, where there is still money to be made?
Well, so Prashant, like I was saying, Indian Hotels and Inox are two classic examples where I think a reasonable amount of money can be made. But, When you say undervalued, you can always view it relative to the industry leader or the sector PE multiple, so to speak. So if you look at financials, for example, and Prashant, we've spoken about this over the last few months. As a house, we've preferred non-lenders over lenders, and I think in the non-lenders, if you look at a name like SBI Life Insurance, which is coming to you on a one-year forward FY22 price to embedded value of about somewhere between 2 to 2.3 times, it is still at a substantial discount to an HDFC Life Insurance. So I think that is one name that could certainly be played. When you're looking at when you're talking about value. I think some value has started to emerge in the consumer electrical space, Prashant. I think names like Crompton Consumer and V-Guard are reasonable places to look at. I think if you look at HPCL, I mean, it's a good dividend yield play. It's a good, free cash flow yield, very strong. I think both the dividend yield and the free cash flow yield on an HPCL would be between 7 and 10%, and the stock would be coming to you at something like 5-6p. So I think there is enough and more value. In infrastructure, you have names like PNC Infra, KNR Construction that are winning orders on a weekly basis. Whether it's 500 crores or 1,000 crores, where the order book to bill ratios are anywhere between 2.5 to 3.5x. So I don't think there is I'm not saying that there's not any value in the market. There is still, you always find stocks to sell even at a 7,500 Nifty. You can always find stocks to buy even at an 11,500 Nifty. But you just need to be very careful about where you put your money. So some of these names I've highlighted, I think there is still reasonable margin of safety. For whatever reason, they may have got beaten out of shape. I think the fundamentals are strong. The companies are doing business, are gaining market share, and I think they will continue to do so. So I think broadly, I think these are some of the thoughts that I have in terms of stocks where I do see value even at this point in time.
Rahul, thanks very much. Appreciate you joining in and running us through what you're making of the situation out there. Thanks indeed. We will take a very quick break here. The market's up about, 42 points. There's enough and more happening. Bank Nifty is, of course, leading from the front, 0.9% gains there. We are back with more on the other side.